Welcome to the Daily Drawdown, a brisk brief on AI IPOs, chips, and market rotation. The market's trying to price two things at once: an enormous AI buildout and the possibility that near-term demand, margins, and liquidity don't support the hype yet. That tension showed up everywhere, from semis and Apple to private credit, oil, and a coming IPO queue that could pull capital out of everything else. The biggest practical risk on the board is a clustered issuance window. OpenAI, Anthropic, Perplexity, and SpaceX are all tied to near-term IPO expectations or confidential filings, and that much supply arriving together can compress timing, pressure valuations, and absorb liquidity fast. This matters beyond the deals themselves. If giant new listings hit while investors are already concentrated in a handful of mega-cap tech names, money has to come from somewhere. That can weaken market breadth, force reallocations, and create mechanical demand later if indexes add the new names. The warning from bankers and analysts is straightforward. A wave of very large, very expensive tech listings, especially loss-making ones, can overwhelm available risk capital in the short run, even if the long-term story stays intact. SpaceX is the most polarizing case. Published estimates are all over the map. From reported retail allocation mechanics around fixed share prices to bullish trillion-plus valuation claims, and that spread alone tells you price discovery is not settled. Critics are focused on valuation versus current economics. Reports describe pricing near roughly 90 to 95 times trailing sales, with an obvious Musk premium embedded, which is rich by any conventional revenue multiple framework. There's also an access problem. A lot of retail and smaller private investors may think they own SpaceX exposure through SPVs and Form D vehicles, but those structures can be opaque, fee-heavy, and not SEC verified. If and when an IPO happens, some holders may find they never had clean primary share exposure in the first place. Watch the mechanics here. Retail allocations, early book closing, and any fast-track index inclusion could force portfolio reshuffling and trigger selling pressure in other large tech names. The valuation debate gets sharper when you look at cash burn. Reported figures suggest leading AI labs are still spending well above revenue, with PitchBook citing OpenAI burning about $220 for every dollar it brings in. The core issue is gross margin. Analysts are still debating whether some top AI providers are even at positive gross margins today, and until that turns decisively positive, trillion-dollar public valuations remain much harder to defend. So the real question for the next leg of AI isn't demand alone. It's whether these companies can convert demand into profitable unit economics before capital gets more selective. That capital selectivity is already showing up in semis. Broadcom put up solid numbers, but the stock still pulled back sharply from its highs, helping drag the broader AI hardware complex lower and knocking the SMH ETF down more than 3% in the move. The immediate read was simple. Good results were no longer enough once near-term catalysts faded. Investors started asking what happens after the first surge of AI hardware spending. Memory is the next pressure point. DRAM prices have reportedly risen more than six-fold, and analysts are warning that chipflation could add around 40 basis points to PCE while squeezing margins downstream. That problem is intensified by market structure. Roughly 80 to 90% of global DRAM supply sits with three firms. So shortages don't clear easily and incumbents keep pricing power. Speculation is picking up too. Micron generated an enormous burst of options premium in a single morning, and DRAM-linked call activity surged, which tells you the market sees memory as both the bottleneck and the trade. The long-term AI investment case still looks massive. Some bank work frames current AI spending at a scale comparable to historic infrastructure booms, with capex potentially becoming an outsized share of vendor sales over the next several years. That scale is why financing matters so much. Equity, private credit, and structured facilities are being lined up to fund compute and chip purchases, including large deals tied to AI infrastructure buildouts. But the near-term tempo is getting questioned. Some market participants say previously purchased NVIDIA GPUs are sitting idle or being subleased, and delays in very large data center projects are being read as a sign hyperscaler spending could slow. If that view is right, the risk is excess capacity in the next 12 to 18 months. If the bulls are right, this is just one pause inside a much longer build cycle. That's the split. The market is trading right now. Under the surface, the tape looks more like rotation than collapse. Investors have been moving out of high-momentum AI and mega-cap names and into laggards, cyclicals, and more traditional sectors. That matters because concentration is extreme. About 20% of the S&P's market cap sits in 6 mega caps, so when those names wobble, the index feels heavier than the average stock list actually is. Breadth signals are mixed rather than disastrous. Measures like the share of S&P names above their 200-day moving average suggest reallocation, not a full breakdown, and top 50 versus bottom 50 performance data points the same way. At the same time, options activity is running hot. Record volumes in the S&P 500 and NASDAQ 100, richer single-stock implied volatility relative to the index, and wider VIX skew all say investors are paying up for protection while still trading aggressively around the swings. One level to watch is the low 30s on the VIX. Some strategists see that zone as a possible washout signal if volatility spikes into it. Apple's WWDC AI reaction fit the broader mood. The Siri upgrade was seen as incremental, light on monetization, and dependent on partners and third-party compute. So the stock sold off over multiple sessions. The market's concern is practical. Limited rollout, no immediate Europe or China availability, potentially higher costs, and no clear proof yet that these features drive a strong iPhone upgrade cycle or new subscription revenue. In housing, the split remains sharp. Existing home sales improved in some recent data, and higher-end builders are holding up better, while entry-level demand still faces mortgage rate and affordability pressure. Builders are leaning harder on incentives, including aggressive mortgage buydowns, but regional performance is uneven with softer Sunbelt conditions and firmer Northeast and Midwest trends. Oil is still an inflation swing factor. Geopolitical incidents near the Strait of Hormuz have kept escalation risk alive, while demand signals, especially from China, remain softer in some windows. Traders are watching whether crude can stay under the levels that would reheat inflation and hit consumer sentiment. Meanwhile, new market plumbing keeps expanding. Perpetual futures and prediction markets are posting rapid volume growth, but the debate is the same one you hear everywhere else right now. Access and innovation on one side, transparency, leverage, surveillance, and systemic risk concerns on the other. For the next stretch, focus on 4 things: whether the IPO queue firms up, whether memory inflation spreads through margins and inflation data, whether hyperscaler capex slows in a visible way, and whether rotation broadens without turning into a full liquidity event. That's the brief for today from the Daily Drawdown. The big theme is simple. Capital is still chasing AI, but it's getting much less forgiving about price, timing, and proof. This episode was generated by Podkey. Create your own at podkey.fm.